Today, folks, we're scanning the entire Canadian markets to try and sniff out those juicy, high-yielding Canadian dividend stocks because right now, woo, baby, Canada is in a growth market, pulling ahead some value, leading dividend yields to be at literal record lows right now. And even though the Canadian economy is stagnating, like GDP is flatlining, unemployment is rising, I'm here to tell you the Canadian stock market doesn't care about your feelings, and we're going to explain to you why the markets are rallying on the back of some weaker Canadian data. So if you're on a path to financial independence, if one day you want to retire early, join me on that journey. Hit that subscribe button, folks, because we're going to take a look at the three sectors controlling most of Canada's economy, with the first one being energy, oil. We all know it. We're seeing it at the gas tanks. Feels great filling up the tank, but it's not helping the portfolio at all, as oil's trading at 5-year lows right now, which is quite astonishing. On the other spectrum, though, making up for some of that lackluster growth, of course, we got precious metals here, guys. And I'm speculating right now that we're going to start seeing precious metals become some of the top 10 companies in Canada, or at least some precious metal producers and miners, because this is like unforeseen. Like, this is unprecedented. I mean, silver's almost at $52 an ounce. I remember JP Morgan said in 2026 we'll likely see gold surpass 4,000, guys. We are mid-October and we're at over 4,100 an ounce. And I'm gonna state it, speculate it, but I think there's some market manipulation here. I think there's central banks around the world have gotten together. They want to bolster their assets, their balance sheets. They're buying up all the precious metal, driving this crazy supply demand slump, maybe even on paper, that is taking us to these levels. And I don't know why or how this is happening, because it's not normal, right? Like, this is not a normal rally. I mean, gold is outpacing crypto. You know how big the precious metal markets are, guys? $30+ trillion, 40 trillion. Like, it's insane. And like, what's Bitcoin's total value? Like barely a trillion or something. Like, I mean, you'd think Bitcoin would be out rallying gold this year, and it's not. So, I mean, that's something peculiar we're going to talk about. And of course, the third and final largest sector, we can talk about financials, right? Like, if you look at the equal weight bank ETF, up 25% year to date. And I mean, we're starting to see companies and banks here trade at record high price to earnings multiples, lowest dividend yields in a decade. But you have to understand, guys, interest rates have come down. The banks have been putting a lot of loan loss provisions aside to protect themselves. And with lower interest rates, that means, there's going to be some strengthening in their mortgages and their debts, which means they can put less loan losses aside, which means earnings are going to bolster, which means dividend yields might even get boosted. So we're going to find out if that's true or not as earnings come out, which you can subscribe for. And the only other sector here you could sprinkle on is maybe Shopify as a tech company, because it's a $300 billion company. It's like the second largest company in Canada. So yeah, we could technically say, hey, this is a sector we're not really looking at because we're looking for dividend yields. So let's get into it. If we take a look at the broader Canadian economy today, guys, coming out of that tariff war, which I still don't think is over, I think we're going to see some real cyclical bumps. I wish they'd last longer than a damn day. I wish we could see a 10 or 20% correction. I'm here for it, baby. I don't mind seeing my portfolio drop 6 figures if I can buy some better discounts and some higher yields out there. But yeah, if you take a look, we're starting to see some precious metal stocks out there start ranking up in the top, 12 stocks, which is great to see, guys. But we're still mostly the banks. Got Brookfield doing pretty well, Enbridge, and we're going to talk about some of these mega caps because that's where some of the deals do lie, believe it or not. But if you take a look at VCE, which represents, the Canadian economy, it's like an index very similar to the S&P 500's VOO. VCE is the ticker, and this is a good recommendation for someone to buy looking for Canadian exposure. But man, this thing used to be like one of the best things you could buy, locking in like a 3.5% yield, and now it's down to 2.5%. And it's up a lot, man. I mean, to see a 20% run up on an index in a year is quite astonishing, outpacing the United States even. And yeah, I mean, it's crazy. It's impressive, right? But a lot of people have to recognize total returns are all that truly matters. I'm just going to state that right now. I'm a total return investor, but I recognize those of you that are in retirement, you might want a little bit more higher yield. You don't want to sell stock all that much. You might just want to collect some cash flow, sell stock when it's up, maybe like it is this year. Regardless, there's only a few sectors right now where I can pinpoint what I would consider deals. And one of them is going to be in the telecom space still, guys. Bell recently released some operational updates on their restructuring, their rephasing to hopefully bolster some growth, which looks very lackluster, leading the stock to kind of crash this morning. I mean, it dropped almost 6% before investors started picking up some of those discounts there. And I wish Bell could do better, but I hate Bell, guys. I don't like their business model. I don't like Crave. I don't like that they're in streaming and entertainment. I hate all of that. So I'm not touching Bell with a 10-foot pole. I mean, Bell is the only company that has got incredibly stable revenue. If anything, it's gone up slightly since 2021, but around $24 billion in revenue, and management has completely destroyed the fundamentals of this company. You'd think if you look at the stock chart, guys, that they were in some crazy crash or correction, or their entire business models were failing. But when you look at the revenue, you're like, what is happening here? Like, obviously, higher interest rates on companies that have a lot of debt, like these infrastructure companies do. I mean, Bell's got $56 billion in debt, but I mean, there's so much mismanagement. And we should be in a recovery phase. I mean, I'm calling for the bottom of the sector. I think we found the bottoms. But yeah, when you take a look at this growth expected, guys, like, even though we might be at a bottom, it's going to be a long crawl out, right? I mean, they're expecting through 2028 to only have 2 to 4% GIGR, growth year over year here. I mean, adjusted EBITDA 2 to 3%, free cash flow 7%, free cash flow after payments of lease liabilities 15%. Like, come on, guys. Like, that doesn't get me all that excited. I really, on the other spectrum, still like Telus a lot. We've talked about this relentlessly. They have healthcare that's growing at an explosive rate with telehealth. They've got security side of their business. They've got almost an 8% yield right now as it trades down about 8%. So I'd be, I'm not buying it here, but if I was looking for an individual stock still, guys, I think Telus is one of the best. I mean, they've actually seen growth from 16 billion to 20 billion since 2021. They've done a better job restructuring. We're going to start seeing those restructuring phases hopefully come in behind us with lower interest rates, which means bolster earnings. That's what I'm expecting. I'm really excited to look at the earnings come out this quarter. But this is the highest yield Telus has ever paid in its entire history, and it's one of the few major AI plays out there. And I'm shocked the stock's not rallying on this, but basically, Telus opened Canada's first fully sovereign AI factory. A highly secure facility powered by NVIDIA and HPE delivers immediate access to cutting-edge AI compute power for Canadian businesses, researchers, and public institutions. Basically, a bit of a quote here. "Today marks a defining milestone for Canada's digital future," said Darren, the president and CEO of Telus. "Indeed, with the launch of our nation's first fully sovereign AI factory, we are maximizing Canada's autonomy over sensitive data." Yeah, I'm pretty impressed by everything that Telus is doing, and I think they've locked in better sectors than many of the other telecom giants have. I don't know why Rogers and Bell have such a fixation on like media. It's like a huge division for them, whereas Telus is like, hey, let's just diversify into like healthcare, AI factories. But Chile, I think it's a company that is pretty good at the value that you're paying for it today, and it can afford the dividends. So you can lock in a great high yield, use that as your total return. And from there, hey, if things start to pick up and we start getting rebounds, to cherry on top of the cake to get some capital returns from the stock price. Now, otherwise, we've been seeing dumb money, and this is the first time I've ever seen like someone pay attention to Canada as an AI play. But dumb money pointed out basically TransAlta Corporation is a new AI play because this company recently just got some permitting approved. TransAlta data center application. They had to wait for some bylaws that apparently just got approved September 4th of 2025, which helped drive the stock up pretty materially here. It only pays a 1% yield. Not really going to be buying any of this, but I mean, this could be a good AI play. I mean, Canada is starting to sniff out with our energy producers and our utility giants that, yeah, there's some opportunity for some AI that might be underappreciated because most people are paying attention to the mega caps in the United States. Another really interesting sector here, guys, that I would pay attention to is the cyclicality that happens with oil. Oil goes through these up and down phases, and I've come to really appreciate Canadian Natural Resources, which is some of the upper weighted stocks in my favorite ETFs like VDY. And it's trading at a great value. And this is a company that typically outbalances the down periods in oil by continuing to scale production. They're in a rampant phase of growth with production scaling, and they have access to some of the largest natural gas and oil deposits in the world. So it's a great place to buy those commodities in the ground at a great valuation and a very great starting dividend yield. I mean, this is a pretty high yield still overall for Canadian Natural Resources. And yeah, I just think they're poised that if oil goes back up, you could get quite a hefty rebound to the upside if their production continues to scale the way it's scaling, which we'll talk about their earnings as it comes around as well. But on the other spectrum of that, if you don't want the oil in the ground, I still think a great utility play, the blood flow of the entire North American world when it comes to pipelines is Enbridge. It's also the largest natural powerhouse company in the Western world when it comes to delivery. I mean, it's likely if you go outside and you have natural gas, if you look at the pipes coming into your house, there's probably an Enbridge logo on that, and we're starting to see a bit of a retracement here, which is great, down 4-5%. If this continues to go down and we start getting closer to that 6-7% yield, that is a great lock in place, because usually a 6 to 7% is more normal, at least in the last 5 years, for Enbridge to be paying. And these are exceptionally sustainable yields out of really sustainable companies, guys. So yeah, that's what I would look at from the energy side of it. Now, we've talked about MCAN as well before. This is a mortgage company that deals with third-party mortgages. They're private. They're the largest private lender in Canada. they're almost $1 billion company today, also retracing back down a bit. This is usually a good company to buy on the dips. So we get about a 10-20% discount. It does have, being a smaller cap company, it goes through these periods of extreme volatility where it can drop, pretty cyclically 10 to 20% at any given time. So I would pick up these dips personally if you're looking to lock in some yields, not as financial advice. I do like this company. I've analyzed it for a while now. Their loans are starting to improve from default rates. They're doing much better than the banks are, and they got more leniency being a private company. So I've always been impressed, and they traded a great valuation with some growth behind them. I mean, if you take a look, the company went from 96 million to 127 million, doing quite well. Again, this is a pretty small cap company. Keep that in mind. It does come with its own risks, but it's just basically a loaning company. They've done pretty well. They have some GIC offerings. Take a look. I still like this company, and I'm paying attention to it. Now, finally, the only other sector out there we got to talk about that's been underappreciated because of how bad it's been performing. 5 years, Canadian Pacific Kansas Railway. This has been kind of the growth of the railway sector, and it's been stagnating. And the dividend side of it, Canadian National Railway, I mean, has basically offered no return over the last 5 years. And people are saying that this could be a real opportunity, largely being dampened by the tariff war, the lack of immigration. I mean, there's so much affecting this company that is primarily just delivering and moving products around. They do trade at a relative premium. I mean, they're not the cheapest company in the world, but I still think right now, if you're looking for a sustainable recession-proof business, because you can't replace railway, they ship toxic chemicals, a lot of things that you can't ship over the road. They have a lot of moats as well, but their dividend yield right now, guys, I'm going to remind you, is the highest yield pretty much in their entire history, with the exception of 2008 and the 2000 dot-com bubble, right? So, and I've told you this time and time again, and it usually works out. You could probably pick a handful of companies that when they go through these cyclical periods of downturns, typically a few years later, they're some of the outperformers, right? And we've seen this as of recently with a bunch of sectors. I mean, the tobacco sector just went through this, guys. I mean, we knew tobacco giants weren't going anywhere, and they're starting to rally back. We're seeing it across the board. I mean, the healthcare sector, if you look at something like Johnson & Johnson that recently posted decent earnings, but is now rallied back to all-time highs after stagnating for 5 years. I mean, if you've been cost averaging into this, you've probably been doing pretty good as of late, locking in those higher yields, which is why I'm telling you, like, one of the easiest plays in the market is to find mega cap companies that have moats that might be going through some cyclicalities, like whether oil price changes, tariffs and just economic shifts. But the fact is those businesses can still remain long-term. Telus, I mean, these companies have incredibly stable revenues. And again, we're trading at these cyclical lows. And again, this is where people usually sell out of them. They hate them, never buy them. That's what they're screaming from the top of their lungs, which leads us into these, suppressed prices. So if you can kind of fight the grain, and that's how I've made a lot of my money in the market, is buying the dips when people are screaming from the rooftop. It's a horrible buying opportunity. We did that with Google as of recently, guys. But I'm just saying, like, these are the stocks that interest me in the Canadian economy. I'll pass the question off to you. I'd love to know what you're buying, what dividend stocks you're looking at, and how you're kind of approaching this incredible growth market that we're currently in here.